Now let us understand the rules of identifying the range of non-directional markets. The rules of non-directional markets require some mathematical calculation. That's the reason we have a separate video for this. So how we are going to mark the range, or how we are going to identify the range of non-directional markets. So whenever the markets are non-directional, the strategies that we can deploy is either short straddle or short strangles. In both the strategies, you need a range. We have to predict the range of the markets, which makes it absolutely clear that markets are going to clear either the within the range or near the zone that you are expecting. Based on it, we can select our instrument, which is straddle or strangles. So the idea of identifying the range is, once we have understood that the pattern and the price structure, the pattern and the moving average is not in sync, that means it's a non-directional market. So we get one point from the pattern, we get the another point, the second point from the moving average. Now if you remember, we are using moving average band, we are using high-low band, and we are using market structure high and market structure low as a price pattern. Now if it's a non-directional market but the trend is bullish, that means price is trading above moving average and you are getting a market structure high. That means it is going to reflect that the markets are going to be non-directional. Now how to identify the range? The first point we are going to get from the price structure, which is market structure high. So we are going to mark the highest high point of the three candles. Because market structure high is a 3-candle pattern, so we are going to mark the highest point of the 3 candles and we are going to calculate the lowest point of moving average. So we are going to plot the channel, MA channel of high-low band. We are going to consider 1 point from the low band. The low point is exactly below the high price of the market structure high. Let's say candle 2 has made the highest point or maybe the highest high among the 3 candles. At that candle, what's the price of MA low channel? We consider that point as our lower band. So that's the range of the market. We are expecting the markets to close below the high level and above the low levels. Low level of MA low channel. So this gives you a broader range. So if you are trading strangles, then you can short call of high channel and put of low channel. So here you can trade strangles. But now if you want to trade straddles, straddle is a median chart. Median chart means you trade call and put of the same strike. To identify that, what we are going to do is, we have to go one step further. We select the high point, which is the highest high of the 3 candle, plus the EMA low channel point. We add that and divide it by 2. So we get a median value. That median value is the strike. We round it off to nearest 50 or nearest 100, depending where the median value is coming. Let's say the median value comes at 19,289. It's very closer to 300, right? Because it's 19,289. Very closer, maybe just 11 points away from 300. So it's ideal that we trade straddle of 19,300. That means we short call, we short put of 19,300 strike. So that's our median range. And we expect the markets to close below, or maybe they end up going to 0, and we see that the market trades somewhere around our median values. How to trade it, we are going to discuss in depth when I discuss the trades. But this is the way of identifying the range. This is the range we have identified when the trend is bullish. Now, if the trend is bearish, the first pattern comes as market structure low. So the lowest point of the 3 candle, we consider that point as the lowest low. We consider moving average high band value and we add that and divide it by 2. So we get a median value. So the idea here is, we are using moving average channel. So when trend is bullish, we consider value from the low channel, and when the trend is bearish, we consider moving average high channel values for our calculation. So that's the difference. When we are trading bullish and bearish, we don't select closing prices because we are using a channel. So trend bullish, use the MA low values, and if trend is bearish, use MA high values in conjunction to market structure high and low values. Add that, divided by 2, you get a median range. When you get a median range, you can trade straddle of that strike. When you get based on high and low values, you get a range. Based on the range, you can trade the strangle of that expiry. So this is how we identify the range of the markets. It is rule based, a very systematic approach to identifying the range. In the next video, we are going to discuss some examples, some trades from Nifty 50. And this setup, this pattern can be traded across all the instruments. If there is a market participation in that instrument, we can deploy the similar strategy. So this works in Nifty, Bank Nifty, Fin Nifty, it even works on stock options. The problem that you will face with stock option is the lesser liquidity in Indian markets. So I prefer that you stick to Nifty, Bank Nifty and Fin Nifty so that you have enough liquidity to short the straddles and strangles of your desired strike price.